Good afternoon. It is Thursday, January 11th, 2:30 p.m. So much to talk about, people. The news is coming in fast and furious. I have a stack of stuff to get to. It gets larger and larger every day, and quite frankly, I don't even think I'll get to it today. But that's okay. I want to begin with something I had said once before. If I owe you $100, I got a problem. If I owe you $1 million, you got the problem. And that's where we are right now, with this push me, pull me relationship between the United States and China. And these last couple of days, China has, shot that arrow across the pond, right? Reeling the markets. And everybody right now is voicing their opinion one way or the other, right? And Mark Twain said a difference of opinion. That's what makes horse racing. I'm just curious. If I'm going to sell something, 1.2 trillion U.S. treasuries, am I going to announce it to the world beforehand? Some people seem to think so. So, China just reminded the United States that Beijing is its banker. Does the United States need China as much as China needs the United States? U.S. bonds sold off on Wednesday, and that may have been the point. Markets took a hit following Bloomberg News reports that cited unnamed sources as saying that officials in Beijing have recommended China, the largest holder of U.S. treasuries, to slow or even halt its purchases of that debt. U.S. stocks on Wednesday snapped a 6-day winning streak, and Treasury yields, already in an upswing, moved higher, with the 10-year reaching 2.597. We talked about that yesterday. Their highest level since March 15th. Bond yields rise when bond prices fall. Was it a political message? China holds $1.2 trillion of U.S. debt, more than any country. When it buys U.S. bonds, it is effectively lending money to the United States. Washington uses bond sales to China and others to help finance itself. So we're able to live this life of luxury and leisure at China's expense and other countries' expense, right? Wasn't it James Baker that said, it's our dollar, but it's your problem? And that's what's going on here. As much as we need the rest of the world, and China especially, right, to subsidize our standard of living, right? China's sitting on $1.2 trillion, right? That's a big IOU, okay? And they're not about to cut the legs off from under themselves, okay, by saying, oh, we're dumping treasuries, or we're halting treasuries, all right? Got to read between the lines. This is push me, pull me right here, right? As these trade wars heat up. So you're going to hear all these carnival barkers out there. The bond market is melting down, right? The 10 years at 2.54. Same as it was yesterday. Same as it was the day before. Okay? It's all very dramatic, and it makes for good videos, but it doesn't really get to the essence of the truth. Okay? The curve thrown into markets this week comes as President Donald Trump appears poised to counter China on its huge trade surplus with the United States, and as Washington loses patience with Beijing over its handling of the North Korea nuclear crisis. China will not lay passive if the U.S. administration imposes tariffs. Beijing's indication that it is not tied to U.S. bond buying indicates more hardball between the world's two biggest economies, said Vishnu Varathan, Mizuho Bank economic. This is political chess right now, people. Okay? Let's not get ahead of ourselves, though, right yet. Okay? Let's see how the pieces come off the board. Making the Treasury's job harder. In a note Wednesday, brokerage firm Jefferies said that if China stops buying treasuries, the market could suffer. U.S. spending is seen rising this year, and most independent analysts expect U.S. tax revenue to fall under the GOP's new tax plan. It goes on and on and on. I don't want to spend too much time on this, but I want to get to the bottom of this article. We've been here before. This is not the first time China has threatened to back away from treasuries. It's not the first time, and it won't be the last time. In 2009, and maybe some of you remember this, because I do. I remember it vividly. In 2009, amid the global financial crisis and early in Barack Obama's first term in office, former Chinese Premier Wen Jiabao told reporters that China has lent a huge amount of money to the U.S. And of course, we are concerned about the safety of our assets. To be honest, I am definitely a little worried. I remember that. The dollar was crashing and China started saying basically, hey, we're a little worried about our investment. Okay? China was the largest holder of U.S. sovereign debt at that time, too. Its treasury holdings are greater now than they were then. Its treasury holdings are greater now than they were then. And back then in 2009, you had the same carnival barkers. You had the same, the dollar's going to collapse, the stock market's going to collapse, everything's going to collapse, okay? The same P.T. Barnums, okay? This is their cash cow. Stop listening to the people that have been getting it wrong. Start listening to the people that have been getting it right, all right? So that's their cash cow. Sell fear, sell drama, okay? CNBC, they're an entertainment show. They're not a serious financial news network, okay? So everything's got to be drama, drama, drama. It's not all drama. It's really not, okay? I'm not saying that this is it's not important what's going on. It is. Let's just not get ahead of ourselves. Let's just stick to the facts as we know them and as they play out. That's all I'm saying, okay? So, putting that aside, a lot in my stack, people, a lot in my stack. I think I'll jump to this. Yesterday, I started to talk about the stock market. Again, not saying I'm shorting the market. I'm out of stocks. I don't need the last 20%. I might be the biggest fool. I don't know. All right? I said it is like this is all one big trade now. Dollar down, everything else up. All right? But there are certain indicators that seem to be flashing. All right? That perhaps the top is in. Because ultimately, what ends a bull market? Technicals, fundamentals, what ends a bull market? At the end of the day, there's just no more buyers. There's no more buyers. Everybody is all in. And we talked about that yesterday, right? We looked at margin debt, right? All-time highs. We looked at cash accounts. Everybody's in. Today, I want to switch gears. I want to look at complacency. Oh, stocks up. They're going to go up. They're going to go up. There's so much complacency out there. And I said yesterday, I was shocked that the VIX was actually like down. Okay? Nothing can rock the apple cart here. The VIX right now, 9.62. It's down again. It's down 2%. This is the VIX going back to 1991. 1991. This measures volatility, right? S&P puts and calls, right? And I mean, this is like all day, right? The VIX. Volatility, right? And it's pretty low, right? It's pretty low. But when we start to really dig into these numbers, you'll see how complacent everyone really is. It's like they're unconscious. Mass hypnosis. It's low, right? It shoots up, right? In 99, 2000, right? That's the tech wreck over here, okay? Makes a little noise in 2003, right? In 2007, right before the Great Recession or Depression, as I like to call it, it's pretty low. Volatility is low, okay? And then we get that huge spike in volatility. Went up to about 60. Kind of came back down. Had a couple more spikes. Reached 40 in 2011. Didn't stay there long. And it's pretty much been coming down, right? We had that little spike, about 30 in 2015. That didn't last long. And since then, this thing has gone down, 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 down. It's currently 9.62. The range has been 8.56 to 17.28. Okay? Not today. That's like yearly. Now, the actual data, this is going back 2000 to 2006, because in like 2004 they changed their methodology. But in 2006, the VIX was only under 10 3 days in the year. November 20th to 21st and December 14th. 9.97, 9.97. 3 days in all of 2006. So between 1991 and all the way up here, it never even, it's low, but it's not as low as it is now. And then in 2007, it was only under 10 1 day. January 24th, 9.89. 1 day. So you had a few days in 2006. You had a day in 2007. Look where you got to go for it to be under 10 again. 2017. Is this not complacency? 2017. May 8th, May 9th, May 25th, May 26th, 6/1, 6/2, 6/6, 7/13 to 7/26, August 7th, September 20th, 21st, 22nd, 9/27 to October 6th, October 11th to October 16th, October 20th, October 27th, right? Spent a good deal of time under 10. Oh, I missed more. November 1st through the 18th, through the 8th. November 21st through the 27th, 12/8 through 12/12, 12/15, 12/18, 12/20 to 12/22, right? So 2006 and 2007, 4 total days combined. And then you got to go 10 years for it to go under 10. And now in 2018, we're off to the races. 1.2 to 1.8, right? 1.9 a couple of days ago. It was a blip over 10. Didn't stay there long. And then yesterday, 1.10. It was down again under 10. And today it's down to this. If this isn't complacency, people, I don't know what is. All right? So we got margin debt at all-time highs. We got complacency at all-time highs. I'm just kind of putting it all together. Okay? Not saying it's going to crash. Okay? Excuse me. Anyway, a lot more on my stack to get to. There just never seems to be enough time. Yeah, we might have to table some more stuff. That very important thing I wanted to get to yesterday, I don't even know if I could get to it. We'll see. The markets, gold doing quite well, 1321. I said yesterday, it could be a little stretched. Well above the 50, 100, 200-day moving averages. Having a nice day again today. I'd like to see it just kind of take a breather maybe. Just kind of consolidate here. Silver really not doing much of anything. Still under 17. The Dow, big day today. Up 140 points. So they weren't spooked very long with this China news. S&P is up. NASDAQ is up. Russell's. The dollar is getting crushed. The dollar is getting crushed. 91.62. It's down 44 cents. Okay? Dollar's getting crushed. No doubt about it. Big pressure on the dollar. Now the 10-year is 2.53. So that really hasn't budged. Now the short end of the curve has come up and the long end of the curve has come down. So this yield curve is flattening. And it's an interesting article I would love to get to. All right, I'm going to probably have to table that. Oil is breaking out, right? 64.29. It's up 72 cents today, 1.13%. Oil is at the point where, a few more ticks up and we could be looking at $100 oil, okay? The cryptocurrency, this is interesting. The cryptocurrencies, right? And I'm going to continue to talk about them. And I got another article I want to get to about the cryptos. And that reminds me, I have something else. They're all under pressure today. Bitcoin is down 7%, 13,832. Ethereum's down 1.5%. Litecoin's down 5.5%. Ripple is down 15% today. So I have a question for all you crypto fanatics out there. Okay? Riddle me this. If these cryptocurrencies are supposed to be a play against fiat currency debasement and protection against, the US dollar and other fiat currencies. So how are these cryptocurrencies getting slaughtered today when the dollar is getting hit like this? Riddle me this, okay? Because I know the answer. They're not a play against fiat currency debasement. They're not a play against the US dollar and inflation. They're not a hedge against all that. They're just momos who don't know what they're doing, okay? Just reaching for the next thing. That's all it is. And I defy anyone to tell me differently. Because the proof is right here. The dollar is getting hit hard today. These cryptos should be all green. There's a complete disconnect between these cryptocurrencies and the US dollar. What might have started out as a pretty good thing, right, for libertarians has morphed into something totally different, all right? I'll just leave it like that for now, okay? Yeah, this video's getting long. I'm going to wrap up with one thing here. There's a book I'd like to recommend. It's called What Has Government Done to Our Money? What has government done to our money? Murray Rothbard, Rothbard. And I picked this book up complimentary from my gold dealer. Must have been at least 10 years ago. Gave it to me. Copyright 1963, 1985, 1990. And I would recommend it. It's a very easy read. It's only 110 pages. Very easy read. I just want to share with you the intro to the 4th edition. Monetary policy is, aside from war, the primary tool of state aggrandizement. It ensures the growth of government, finances deficits, rewards special interests, and fixes elections. Without it, the federal Leviathan would collapse, and we could return to the Republic of the Founding Fathers. Our monetary system is not only politically abusive, it also causes inflation and the business cycle. What is to be done? In answer to that question, the Mises Institute is pleased to present this fourth and slightly expanded edition of Murray and Rothbard's classic, What Has Government Done to Our Money? First published in 1963, this is one of Professor Rothbard's most influential works, despite its length, which is brief. I can't count the number of times academics and non-academics alike have told me that it forever changed the way they looked at monetary policy. No one, having read this book, hears the pronouncements of Federal Reserve officials with awe, or reads monetary text with credulity. What Has Government Done to Our Money is the best introduction to money, bar none. The prose is straightforward, the logic relentless, the facts compelling, as in all of Professor Rothbard's writings. His themes here are theoretical, political, and historical. On theory, he agrees with Carl Menger and Ludwig von Mises that money originated through voluntary exchanges on the market. No social contract or government edict brought money into being. It is a natural outgrowth of individuals seeking economic relations more complex than barter. But unlike other commodities, an increase in the stock of money confers no social benefit, since money's main function is to facilitate the exchange of other goods and services. Indeed, increasing the stock of money through a central bank like the Federal Reserve has horrific consequences, and Professor Rothbard provides the clearest explanation available of inflation. In policy, he argues that the free market can and should be charged with the production and distribution of money. There is no need to make it a monopoly of the U.S. Treasury, let alone of a public-private banking cartel like the Fed. A successful money needs only a fixed definition rooted in the commodity most suited to a monetary use, and a legal system that enforces contracts and punishes theft and fraud. In a free market, the result has been and would be a gold standard. In such a free market system, money would be convertible domestically and internationally. Demand deposits would have 100% reserves, while the reserve ratios for time deposits would be subject to the economic prudence of bankers and the watchful eye of the consuming public. There's a little bit more to this introduction, but I think you get the point. I would recommend it. I don't know if you can get it, if it's in print or anything. Like I say, I got it for free, but a good read. Anyway, that's about it, people. Let's just try to stay focused, and let's just use what we have, okay? And not let's just speculate here. There's just too much of it. Anyway, beautiful day out there today. Matter of fact, you might not tell from how it looks, but the sun is coming in through the window. I actually had to put a curtain up just to block the sun. But it's gorgeous out there. If you can get out, take a good long walk today. Enjoy it as we get into the midst of winter here. Lord willing, we pick this up tomorrow. Ciao.